Well, good morning. Welcome to this month's Life webinar. I hope everyone had a happy Valentine's Day. And you're in for a real treat today. My name is Mark Lyons. I'm the Director of Sales here at SMS Financial Solutions. And we have a very unique program. Today, we're being joined by several of the people of the Life team and several of the people over at Mutual of Omaha. And we're going to be sharing planning ideas with Mutual of Omaha products. It's something that we've never done before, but we thought, well, what better way to say Happy Valentine's Day and to help you show your clients how to insure the things that they love, whether it's their family, whether it's their business, whether it's their own finances, we have an idea for you. So as we go through this seminar, we're going to share these ideas, and at the end, you'll have the opportunity to say which idea that you thought was the best. So we'll have a little vote. If you vote, you have the opportunity to win some Mutual of Omaha swag in a drawing. So I hope you'll stay tuned to the end. Just a couple of housekeeping items. We do have the ability to take questions today. So just post them in the question and answer section. Do not put them in the chat box. We will not see them. Our answers will probably be online at the end of the session. Make sure that if you have any questions, get them in. If you don't want to ask a question during the session, if you're already somebody that's with SMS Financial Solutions, just go ahead and then call your life marketer if you want to learn more. If you're not with SMS Financial Solutions already, we'll have our contact information at the end of the presentation, and you can either call us or email us, and we're happy to talk to you and help you out in whatever way that we can. So joining us today is going to be the members of the Life Department team. Yours truly will be participating. And then we have our marketing consultants, Laura Harrell, Steve Velasic, Tom Pecoraro, and Matt Hayes. We also have three folks from Mutual of Omaha. So we have our RVP, Mike Marasco, joining us here today and sharing his idea. And then we have Ron Lee, who's the Vice President of Advanced Markets. And then we have Michelle Owens, who actually heads up the Advanced Markets Department. So with that, we're going to get started. So the idea I would like to share today is 2 is better than 1, estate planning with IUL. Question: what is better than one $2 million IUL policy from Mutual of Omaha? The answer is 2 $1 million IUL policies from Mutual of Omaha. And so let's look at this concept a little bit more. With most life insurance policies, there's an idea of a band break. And as the face amount gets larger and larger on insurance policies, at some point you have what they call a band break. And for Mutual of Omaha's policies, you get a band break at $1 million of face amount. So what that means is that 2 $1 million policies will cost the same as 1 $2 million policies. So why is this concept important for us in planning? So really, the reason is for flexibility. Now, I looked up this definition the other day for flexibility, and it's the ability of muscles, joints, and tissues to move through unrestricted, pain-free motion, allowing for optimal movement and function. And it's the same with the life insurance. 2 things that we're looking for in the future. Pain-free is one of them, and 2, optimal function. So let me go through some scenarios when you might want to use this idea. And I'll say this one thing too. Many of you probably are thinking that, oh, I don't want to fill out 2 applications for 2 different policies. you only need one application. So even if you have $5 million of death benefit need, you only have to fill out one application and you still have the ability to get five $1 million policies. But again, let's look at why it's important. So Mutual of Omaha has IULs that always come with a no-cost accelerated benefit rider for chronic illness. But that policy benefit is going to be limited on a per policy basis. So what you have is the ability to, if you take out two $1 million policies at no more cost than a $2 million policy, to double your benefits. So that's one reason. Also, and related to that, you have the idea that you can choose one policy to have a long-term care rider and one policy to choose the no-cost chronic illness rider. And so what that does, for almost a similar benefit, it's much less expensive. And then when the time comes for a claim, you have choices. Would you rather pull the money out of a long-term care rider, or would you rather use the chronic illness rider? It all depends. It all gives you choices. Also, people's needs change over time. So you may want to transfer one of those policies to a trust or a charity or other third party. So just let's look at the charitable example. People's needs change. They don't need $2 million of death benefit anymore. They only need $1 million. So what you can do is gift the $1 million policy and keep $1 million policy for the benefit of your family. But when you gift the policy to a charity, all the premium payments that you're going to be making in the future are going to be tax deductible. So that's an idea. So if you want to fund a trust, maybe say have the one trust that's for the benefit of one family member and another trust that's going to be for the benefit of a different family member, you can transfer those policies to two different trusts. Or the idea is to transfer to a third party. Let's just say you have two children and you can't afford the premium payments anymore and you don't need the death benefit, but you've been paying on it for a long time. And maybe the children are saying, well, we'd like to keep the death benefit in case you pass away. So if you have one policy, you can give it to one child. And if you have the other policy, you can give it to the other child. And maybe they make the premium payments for you. And so it essentially becomes their policy. Or if you want to, settle the policy, you have that ability too. Perhaps it's changing business needs. Perhaps a business owned a $2 million key man policy. A lot of times at the end of maybe in a period of time when the worker sticks with the business, they may kick that policy out to that employee just to say thanks for being around for the last 20 years. But if you have two policies rather than one, maybe it's time to kick one policy out, after a period of time, but then you still have the ability to incentivize the employee to stay around for a little bit longer. And then at the end of that term, you'll kick out the other policy to that person. And then one last idea, and this one's a little bit different, but Mutual of Omaha has a income advantage accumulation policy. And also they have a more guaranteed death benefit type policy that's called Life Protection Advantage. And so rather than just have a $2 million death benefit, and you really have to pick, whether you're going to be an accumulating policy or you're going to be a purely death benefit policy. Maybe you have both. So you could split it into two $1 million policies. You could be using one of the policies for accumulation purposes and another one just to make sure you have the additional death benefit that you need. And so it works very well because one of the keys to accumulating money in a life insurance policy is to reduce that death benefit as much as you can for the premium payment that you're going to be making.
All right, hello everybody. My idea today revolves around married clients who'd be looking to Social Security as a source of income should one spouse pass away. And there's two situations where your client's misunderstanding of how Social Security actually works might cause them some big problems in the future. So the first situation is very problematic for couples with young children. Let's say your clients are worried about providing for children should one of the worker spouses pass away. They would receive Social Security, right? Yes. Generally, if a spouse that qualifies for Social Security dies when the children are young, the surviving spouse does receive a benefit and the children themselves receive a benefit. And that sounds great, except benefits to that spouse stop when the child reaches age 16, unless that child is disabled and the disability happened before they were 22. Now, I don't know about anybody on the call here today, but my kids didn't get off the payroll at age 16. So that is not a great solution. In addition, the benefits to the child then would actually stop when they turn 18, unless they're still in high school. Then they would receive it until they're age 19. So what do they do in the meantime? Isn't there going to be a significant shortfall in the amount of income that they're receiving? But not only that, there's also this question about the earnings limit. How do we handle that? We know that if they earn more than $24,480 in 2026, for example, they're going to lose $1 of benefits for every $2 that they earn above that limit. And so maybe Social Security just by itself isn't a great strategy for people with young children. Then the second situation may be even more misunderstood than the first. What happens when both spouses are receiving Social Security retirement benefits and one of them passes away? Well, the answer is that the survivor gets the greater of the two benefits, but not both benefits. So while it's good that they receive the higher check, oftentimes their living expenses may continue on the same pace as they were before. For example, the mortgage payment doesn't go down, the utilities are no less expensive. So, what should they be thinking about doing to replace their income? The answer, of course, is life insurance. We all know that everyone with a spouse and children needs to make sure that they buy enough life insurance to take care of the family, replace the income, pay the mortgage, send the kids to college, and so forth. But are these young couples considering that there will be a period of time when they won't be receiving assistance from Social Security? Likewise, after retirement, are they really expecting that Social Security, which for most people isn't enough anyway, will somehow magically be enough and sufficient for their needs once one of those checks goes away? Of course, a proper needs analysis is always best, but in those cases where you just need a quick number for the clients looking to replace a lost retirement check, just take the amount of the lesser check and multiply it by the number of months that they want to protect the income. For example, if the lesser benefit were $1,000 a month and they wanted to protect the income for 20 years, that would be 1,000 times 12 times 20 or $240,000. It's a quick and easy way to make sure that your clients don't suffer financially from the loss of a check. So, who should you be talking about with these ideas? Well, for the first idea, everybody who has kids and might depend on Social Security. For the second idea, think about everyone at or near retirement. Med sup clients, clients with retirement plans to roll over, those doing estate planning, and so on. Your clients need you to help them understand where their plans fall short. So, regardless of why people initially came to you, make sure you bring this up. Their loved ones will thank you someday.
Hello, everyone. Tom Pecoraro here, Senior Market Sales. Glad to be participating in this. Wanted to kind of start with IUL is a strategy and not an investment. We can design the best policies in the world, but if you position them wrong, the case dies, or even worse, it gets missold. IUL isn't about built to win on one category. It solves three problems at the same time. So first and foremost, protection first. Everything begins here. This is life insurance, meaning that death benefit that lasts a lifetime, and that benefit passes tax-free to beneficiaries. So before we ever talk about growth or before we talk about accumulation, we're solving the core financial risk every client has, and that's premature death. Protection isn't the only one feature of an IUL, it's at its foundation. So, number two, controlled growth. Now, on top of that protection, we layer growth, right? So, cash value that's linked to a market index. But there's a key difference here from, investments, and that's a zero floor. So, when the market goes negative, the policy doesn't lose due to market performance. So now that also then leads to number three, which we talk about in IULs, is the third problem IUL solves is, and that's the tax efficiency. So again, going back to as long as it's structured properly, clients can access cash value through policy loans, and that means potential tax-free income without triggering a taxable event. So the big thing we want to talk about here is when you put it all together, you've got protection, controlled growth, tax advantage access. So this is not an investment project. This is a financial strategy. So yes, you don't get full market upside. What you get is participation without downside. Clients aren't trying to beat the market here. They're trying to avoid market damage. So IUL isn't where you chase returns. It's where you protect gains. When clients are looking for upside without downside, tax efficiency, and lifetime perfection, your role isn't to show them an investment illustration, it's to show them a strategy. So the market bucket is where clients go for growth, but it comes with volatility. Bank bucket, this is where they go for safety, but growth is minimal. So when we talk about the bucket strategies, the IUL sits in the middle and it's unique. It provides protection, controlled growth, and tax leverage. Your role isn't to show them an investment illustration, it's to show them a strategy. So the three position anchors, strategy over product, protection over performance, structure drives outcome. Thank you and have a great day.
Hi, my name is Michelle, and I appreciate you guys letting me participate in your contest. I want to share a sales concept that I think you guys can use with really any retirement income planning situation. It might even start with a client who's asking you about Social Security, or they have a long-term care question, maybe a med sub question, right? It's something to me that you'll be able to discuss or get into what is their retirement income strategy. And when you can carry that conversation over into looking at retirement income, into looking at what they've been able to accumulate, what I like about that is you're going to be able to figure out who feels secure with their current retirement income plan. And you'll probably be able to identify with some of those clients that feel good about where they're at if they're going to have excess assets. When they have those excess assets, they should be talking about then what do they want to do with those? Is it leaving a legacy to their kids? Because a lot of people, when you have single, individuals or married couples, most of them with their legacy plan look at what they want to leave to their kids and how they want to do it. Unfortunately, what happens maybe before they've talked to you is they don't understand when assets pass to their kids, some are going to be more efficient than others. And so I want to help you guys talk about and have a conversation to educate clients as to a real secure way to not only have that retirement income, but a secure way to set up a legacy plan. When they're looking at their qualified retirement plan assets, a lot of times they don't understand that the IRA that they have, the 401k that they have, that they just assume will pass to their kids with anything left over. They don't know that if they're in an estate tax situation, that asset will be hit with estate taxes. Their beneficiaries, when they inherit that asset, they will owe all that tax deferral at that beneficiary's tax rate. They also, with the Secure Act now in place, will have to pay those taxes quicker. The Secure Act kind of shed new light on this concept. A lot of people talked about this as wealth transfer or capital transfer. We like to call it secure transfer because of the Secure Act and this new 10-year tax collection rule that they put on most beneficiaries nowadays. So if you have clients, let's in this case consider this client. Her name's Judy, and we'll say she has a sizable estate. We'll put her in a situation where, as you're talking to her, you start figuring out she will probably owe estate tax and she will probably have excess qualified assets to pass on to her kids. So if you talk to her and she understands the amount of taxes that could be owed and could be, taken away from her children, go to the government instead of her children, she would be interested in talking to you about ways to make that legacy plan more efficient. When we look at this example, if we just assume, and we're going to be conservative here, that she has around 300,000 of excess assets, if that estate of hers is going to be susceptible to estate tax, you can see right now in our current tax environment, the estate would owe 40% of that value at her death. So she would be giving up, potentially passing on 120,000 to her kids of that IRA right off the top. Then let's assume the kids that are inheriting this, if they're in a high tax bracket as well, the income tax that would be owed federally. So I'm not even looking right now at state income tax or state inheritance tax issues like we have here. We're just looking federal. That could be another 111,000 off that IRA. So you're looking at a legacy plan where she thought she was passing on 300,000 and now she's potentially only giving her kids less than a third of that. This is where, to me, if you were talking to Jane and you said, what if I could make sure that your kids inherited an asset that had no market risk, that had no tax risk, and day one, I could triple the size of this IRA excess that you have, how would you feel about that? Would you want to talk more about it? I think this is a good strategy because you're not only securing her legacy, you're making her feel better. You're giving her peace of mind. So with life insurance, what I like to look at, and a strategy that I use here is to say, if we took that 300,000 in Jane's case, and we used a SPIA, something that would guarantee those annual premium payments into life insurance. That SPIA right now could produce a little over 18,000 a year based on her life. The payments, and I want to be fair with this, if I use the after-tax amount, assuming she's in a high tax bracket as well, I could get a little over $11,600 to use towards a face amount for this policy. In our life protection product, that product is going to give her a much higher death benefit, tax-free to her kids, for guaranteed till she's 90, for a low premium cost. That's what this product is known for, is the low cost with this nice guarantee out to age 90. So we look at this, we're able to turn 300,000 of a qualified asset that was open to market risk, had significant tax risk, and turn that into something that's a guaranteed 970,000 of tax-free death benefit for her legacy plan. With this, it also gives her the ability and flexibility to change her mind, because our product, the life protection product, it allows individuals to have a guaranteed refund option. It's for anyone age 60 and under, that they can actually get a full refund of premium in years 20 through 25. And so for her, if you think about it, we purchased this when she's 60. She's able to actually get full refund of premium if she changes her mind. She also has that chronic illness and terminal illness rider that are put on the policy free of charge as well. If we wanted to get into discussions on, how to structure this with an IUL, how to maybe make it a little more secure, she could add a living benefit of an LTC rider. There's a lot of options here for her. But what I love about it is we've secured that legacy plan for her, as well as maybe given her the ability in retirement to spend a little more, feel better about her retirement income, knowing that she has her kids taken care of. What I wanted to cover last in closing is just you guys have access to a lot of different tools. I don't know if you've been out on our sales professional access page, but the concept that I talked about, secure transfer, there's tools there for you. There's a seminar that you can use that has client scripting. It's been approved for client use. We have flyers that are available, case studies that you can show to clients. Each of our sales concepts, we try to put tools out there. So there's a number of different concepts. If you guys have questions on any of them, feel free to give us a call and let us know. We're happy to discuss your specific client in detail. Thank you.
I'm Matt Hayes from our life insurance team here at SMS, and I'm going to be talking about beneficiary reviews today. So, when should a beneficiary review be done? At minimum, they should be done annually. You can feel free to do them whenever you'd like throughout the year, but at minimum, I would do it annual. Either at the end of the year or at the beginning of the year is a good time frame. Some people like to do it right after tax season, maybe after EEP. It really is up to you, but at least once a year at minimum. What would be the cause or the reason for a beneficiary review? Well, things such as a marriage or a divorce. We've all seen statistics out there, varying numbers, but roughly they say about 50% of all marriages these days end in divorce. So why would you want your money ultimately going to somebody that is that you're no longer married to anymore? Birth, adoption, death of a beneficiary, or other opportunities. Here at SMS, we have a lot of advisors that work with the senior market, predominantly on the Medicare side. And how many folks have had new grandchildren born in the past year? So it's an opportunity to review that with a client and dig a little bit deeper into their lives and how you can best be of assistance. There's also lifestyle changes. Maybe you've had a new job that's brought on more money. Maybe you've brought on or been the recipient of an inheritance, or there's lottery winners. Now, I myself, I've never been one, but I know that those folks are out there. And then also wills and trust. That adds another reason why you should review beneficiaries. Maybe there's been a move involved. So many different things are opportunities to really kind of sit down and almost do a fact finder with your current clients that you already have. So what should you review? Well, quite frankly, everything. Nothing's off the table. But I think you should offer to look at any life insurance policy, no matter if you were the agent of record or not. It's an opportunity for you to kind of take a peek under the table and really see what somebody has and peel that onion back. You can use so many different narratives or adages, but it's true. Looking at somebody's life insurance policy helps you figure out maybe there's a discrepancy here or something that I could do where I could offer a policy that they have a deficiency in. And maybe it's not life insurance. Maybe it's a long-term care plan, all different things that SMS can help you out with. And allows you an opportunity to build rapport and potentially uncover that new sale, which I just spoke about. We all know and we all talk about stickiness. The more policies you have with somebody, the more opportunities there are to create where they're going to be advocates for your business. And, our folks over at United Mutual of Omaha, we do all sorts of business with them, not only on the life insurance side, but we have some other areas of business as well. And just a few other items of note here. When you do a beneficiary review, you're putting your clients at ease. It's one less thing for them to worry about because they've made sure that they're up to date on everything. And it's a good time to remind your clients that life insurance proceeds to a beneficiary don't go through probate and generally and often tax-free. And you want to make sure to remind your clients, and this is a good reminder for advisors as well, don't forget about those contingent beneficiaries. Be prepared and have a plan, even in death. Take care of what you can while you can. So, thank you for joining us today.
Hi, everyone. Laura with Senior Market Sales Financial Solutions. My sales idea for the day is using Trump accounts as a door opener. So there's been a lot of buzz about the children's Trump accounts as part of the One Big Beautiful Bill. What they are is any U.S. citizen child under the age of 18 can have one of these accounts. But the really important piece of this is any child born between January 1st of 2025 and December 31st of 2028, you can get $1,000 of seed money that is put into this account. So what they're really designed for is kind of a starter retirement or savings account with tax deferred growth. Parents or guardians manage the account as custodians until the child turns 18. Individuals can contribute up to $5,000 per year, and employers can contribute up to $2,500. And then some employers are actually matching an additional $2,500. Parents can sign up using the IRS form 4547, and the link is in this. So that's who can sign up. But what I really want to talk about is the differences of the Trump accounts versus talking to your clients about using life insurance on children as an alternative to the Trump account. So pros of using life insurance: it does provide a death benefit. Life insurance is always life insurance first. We can design life insurance using IULs as overfunded. And so all of those cash accumulation can grow inside of the policy. The policy owner can take out cash later on as a tax-free distribution. The withdrawals can be used for anything. They don't have to be for college, first-time home purchases, retirement savings, or other qualified uses. So, think outside the box when you're using an IUL for cash accumulation. You could maybe use it if your child wanted to start a business when they grow up. Maybe if they want to buy their first car, they can use it for college if they want to. But it doesn't have to be limited to only certain items. There's no penalty for taking cash out early versus when you use a retirement account and take cash out early, there potentially is taxable consequences and penalties that you have to pay. Using an IUL, there's no penalties. The other piece that I really like on getting insurance for children is that guaranteed insurability piece. I don't think people really talk about it enough. That guaranteed insurability is huge. When you take out life insurance on a child, it protects them if anything should happen to them in the future. Think about how many children potentially have diabetes later on in life, mental health issues, have cancer, all of those health issues that maybe you don't think about children having, but it protects them. They also have living benefits such as chronic and critical illness riders that are automatically built into the life insurance policy. And then contributions aren't limited like on a Trump account. So there's no maximum amount that you can put in. They do have to follow financial suitability guidelines. And we can work with you on structuring IULs that are going to be beneficial for both the client, the child, and making sure that they're structured the right way and how the clients want them. But I think the biggest piece is there's tons of options and you're not limited to the constraints of just a retirement account. And that's why I love talking about life insurance for children. And I think it's a great door opener. Thanks for joining us.
Hello, everyone. Mike Marasco with Mutual of Omaha. Here to talk to you today about some ideas when you're talking to people about their final expense. Obviously, we have our Living Promise product, but why not take in consideration an alternative that may offer a more compelling solution for your customers? Let's talk a little bit about our Living Promise and then take a look at our IUL Express product. On the Living Promise, this is obviously a very steady plan for us. It's a great product. We will issue that from ages 45 to 85 for the plan that will go up to $50,000. If they do not qualify for that, that will bring the issue ages down to a maximum of 80 and to a maximum amount of $20,000. These are very good policies. They're guaranteed to age 100 if the premium's paid. The thought behind this is that many times people are not looking to just purchase the death benefit. So we do have some Living Promise benefit plan riders on here. One cost rider is an accidental death benefit rider, and we have some no cost riders, accidental death benefit rider for terminal illness or nursing home confinement rider. These are very good, but they're a little bit limited in scope compared with the Index Universal Life product that we're going to talk about. One of the things that I think is very important and for somebody to take a look at when you are talking about the final expense is the face amounts. Okay. A lot of times when you're talking about final expense, people are thinking, cost of burying, things of that nature. But there might be some other considerations in there. And some of these people who are talking to you about final expense know that they have more than those type of expenses to deal with. But when they think final expense, they're thinking burial, and hopefully I can do some other things to help cover some of those other expenses. Now, if we take a look at this Index Universal Life Express, we can see that we have substantial opportunity for a larger face amount of the life insurance. Now, let's understand that realistically, people looking for final expense are probably going to be more in that 50 plus to 75 age range. So in here, when you're looking at a maximum amount on the Living Promise of potentially $50,000, now you have a lot more room to work with here as far as face amounts go. And this is a very good policy. It is an Index Universal Life policy. There's plenty of opportunities to access cash and have them grow and utilize the cash value. These policies are also guaranteed for 20 years or until the person turns age 80. There's also a lot more value to the no-cost riders. There are living benefit riders for terminal, chronic, and critical illness. So they can accelerate a portion of that death benefit to cover those. Waivers of surrender charges for partial withdrawals and guaranteed insurability rider. And there is a lapse guard rider, meaning if they decide to pull income out of this policy, it will never lapse, causing them a taxation situation. So there's a lot more to look at in this policy than the final expense policy alone. We do have some cost riders on this policy as well. However, I think those aren't necessarily things that need to be added on for this product to work very well. So when I want to wrap this up, I always take a look at, what are the advantages of the IULE versus our Living Promise? Higher face amounts. That is the number one thing to look at. We have a broader scope of living benefit riders on there with no cost, and even at the cost riders. And if you were to do a look and a comparison, you were going to potentially get more coverage for a similar outlay of premium dollars. If you run these things, you're going to probably find that the discrepancy in the value of the premium dollar is not as much as you would think. And many times it's often less to utilize this IUL Express product. So that is my idea, is to have that discussion about the IULE when you're talking to people with the final expense. The other thing I want to mention, in keeping with Mark's theme of Valentine's Day, most of these people who you're speaking with are likely to have grandchildren. So why not make that pitch for a children's whole life policy at the same time you're talking to them about their final expenses? Because they can purchase, if they're grandparents, these policies on their children. Thank you for your time.
Good afternoon, everyone. Steve Velasic, life insurance marketing consultant here at Senior Market Sales. We're going to talk about redefining your life insurance with long-term care riders. We dive into a lot of policy reviews with people and tell them the importance of going into their current existing clients and working with them on what they currently have and reviewing it and seeing what they have for the ability to make their products a little bit better, give their products, their agents a little bit more, or excuse me, their clients a little bit more ability to do something with those policies. What we're going to talk about is an individual that has an existing life insurance policy with roughly about $75,000 in cash value in the product. They're paying about $200 a month and have roughly a $100,000 DB with no living benefits. As we know, a lot of the older policies that have been around for 20, 30, 40 years, they don't have a lot of the benefits that majority of our new products do. So being able to put them and repurpose them into a new policy is a big advantage just in that, let alone anything else that can happen within that policy. So this individual, they don't really have a life insurance need anymore. The kids are out of the house. Going into retirement, the house is paid off, they have assets, but they really understand what life insurance is and what it can provide. But if they're going to keep it, they want it to be able to provide and be as maximized as it can. So what we're talking about here is an individual that's 65 years old, like I said, doesn't really need life insurance. They don't have LTC, but they truly see the need. They understand the importance of what long-term care can do to them and where it can come into play for them, in their family and in their livelihood, because they've seen the cost of care, whether it be with family, friends, mom, dad, grandma, grandpa. They understand what the need is. And they're concerned with paying both the LTC and maintaining the life insurance policies. They want to have the life insurance. They understand what the life insurance is for, what it can provide in regards to a tax-free death benefit and helping, whether he predeceases his spouse or it goes directly to his kids. Understands that, is concerned with the cost of long-term care, because he knows long-term care premiums are not cheap anymore. They are definitely much more than what they used to be. So what we're going to look at is taking and doing a 1035 exchange, in exchanging that cash value in the existing policy. We're going to use the Protection Advantage IUL and current life policies, the cash value, using that $75,000 from the existing policy, bringing that over. Now, we're just looking at just a standard rate for this. These are the numbers we used. Didn't dive into anything crazy with preferred plus. Just an individual that's in good health, is able to go through the underwriting, is able to get coverage. We looked at the $75,000 replacing that existing policy, and he chose to maintain that $200 a month. And $200 a month, he said, I've been paying it for years, may as well keep it up. We'll see what it comes back at and see if we need to look at, changing anything. So went through, ran these numbers on this particular individual. We were able to turn, by repurposing that life insurance, we were able to put this individual in a much better position moving forward than they are right now with their current life insurance. By doing it, we were able to provide a $250,000 death benefit. And on top of that, we threw a long-term care rider on there that's going to provide $10,000 a month of LTC for 25 months. So not only were we able to increase his death benefit substantially, we're adding on that long-term care. He's been paying it. He's got $75,000 in cash in there. And so we're peeling that off, paying $200 a month, what he's been paying for years, and putting him in a much better position. This policy is going to work a lot better for him moving forward. Plus, the other nice thing is we're adding $150,000 of death benefit to an already good policy. So going through and looking at your client base and looking at your seeing what they have available for you is a great way to leverage some of the new products that have been coming out that are available in the long-term care market space to help your clients grow. That's what I have for you today. Please give me a call, Senior Market Sales, and thanks for your time.
I want to thank everyone for joining us today. I hope you found the ideas that we shared valuable, and you're able to institute them in your practice. If you have any questions at all, we're here to help. You can reach us by phone, you can reach us by email. If you already have a life marketer, you can contact him or her as well. If there's more of a technical question, for the advanced sales team at Mutual of Omaha, we can get you in touch with them as well. So we really enjoyed doing this webinar today. It's something I'm hoping that we'll do again in the future. It's different, it's fun, and it was a really rewarding experience, and I hope you found that too. And so now it's time for you to cast your vote for the idea that you like best or you think was the best. You have 8 ideas to choose from. As a reminder, if you do vote, you will have the ability to win some Mutual of Omaha swag, and we'll contact you and to let you know that you won that. So please pick the idea that you like best. And we appreciate everyone for joining us today. And thank you again. We hope to see you next month on another life webinar from SMS Financial Solutions.